studying your last two. I swim med when turned in. The staring out to mute. And can learn the pole that sunk he died.
For many years, tax planning has emphasized one message: maximize your RRSP contributions whenever possible. And for many taxpayers, that advice is perfectly appropriate. RRSPs provide an immediate tax deduction, allow investments to grow on a tax-deferred basis, and help build retirement savings. However, experienced tax advisors note that RRSPs are not automatically the best solution for every client. The best strategy depends on the client's entire financial picture, especially what their retirement income is likely to look like many years from now. Let's consider the example of Deborah and Tony shown on the left side of the slide. They are successful corporate owner-managers with strong incomes and significant retirement savings. Like many business owners, they have several possible sources of retirement income. Their corporation can continue paying dividends. They may receive CPP and old age security benefits. They may have investment income, and they may also have substantial RRSP balances. If we focus only on reducing this year's taxes, maximizing RRSP contributions appears to be the obvious choice. But that's only part of the story. The right side of the slide explains why holistic planning is so important. A professional tax advisor doesn't look only at current income. They also evaluate the client's expected retirement income, future tax brackets, pension income, potential old age security clawbacks, corporate income, and overall investment strategy. Each of these factors affects the client's lifetime tax bill. For example, a client who expects a large pension and significant RRSP withdrawals may remain in a high tax bracket even after retirement. In that situation, today's RRSP deduction may not provide as much long-term benefit as expected because future withdrawals will also be taxed at relatively high rates. That's why experienced tax advisors compare two different paths. The traditional RRSP strategy focuses primarily on today's tax savings. It often assumes that retirement tax rates will be lower and may not fully consider future mandatory RRIF withdrawals or the impact on government benefits. A holistic planning approach is different. It considers both today's taxes and tomorrow's taxes. Instead of asking, "How can we reduce this year's tax bill?" it asks, "Which strategy will produce the lowest total tax over the client's entire lifetime?" This shift in thinking is illustrated by the magnifying glass at the bottom of the slide. Rather than concentrating on this year's tax return, professional tax planning focuses on lifetime tax. Every compensation decision, investment choice, and retirement strategy should be evaluated based on its long-term consequences. This is one of the biggest mindset changes for new tax preparers. Good tax planning doesn't stop at finding the largest deduction today. Great tax planning considers how today's decisions will affect retirement income, future tax brackets, and government benefits many years into the future. In the next slide, we'll compare RRSPs with non-registered investments and see why, in some situations, paying tax only on investment income can actually produce a more tax-efficient retirement strategy than relying exclusively on RRSPs. Now let's compare two very different ways of saving for retirement and, more importantly, how they are taxed when you eventually use the money. At the top of the slide, you can see the complete life cycle of both investment strategies. Let's start with the RRSP. When you contribute money to an RRSP, you receive an immediate tax deduction. That deduction reduces your taxable income today, which is why RRSPs are so popular. While the money remains inside the RRSP, all investment growth is tax deferred. You don't pay tax each year on interest, dividends, or capital gains earned inside the plan. However, the tax is only postponed, it is not eliminated. When you eventually withdraw money from your RRSP, every dollar you take out becomes fully taxable income. The government treats the withdrawal just like salary or other ordinary income. Now compare that with a non-registered investment account. Here, there is no tax deduction when you invest the money. You are investing after tax dollars. During the investment period, interest, dividends, and capital gains may be taxed according to the normal tax rules. But the important difference comes when you withdraw your money. Let's follow Tony's example shown in the middle of the slide. Tony has two possible strategies. In the first path, he pays himself a salary, contributes to an RRSP, receives an immediate tax refund, but knows that every future withdrawal will be fully taxable. In the second path, Tony receives dividends from his corporation instead of salary. He invests those after-tax funds in a personal non-registered investment account. The investments grow over time, and when he eventually withdraws money, the tax treatment is very different. The example at the bottom of the slide clearly illustrates this difference. Suppose Tony withdraws $10,000 from an RRSP. The entire $10,000 becomes taxable income. Every dollar of the withdrawal is included on his tax return. Now consider the non-registered investment. Tony invests $10,000, and over time it grows to $15,000. When he withdraws the full $15,000, the original $10,000 is simply the return of his own capital. He has already paid tax on that money before investing it, so it is not taxed again. Only the $5,000 of investment growth is subject to tax. And if that growth is a capital gain, only 50% of the gain is taxable. In this example, only $2,500 becomes taxable income, compared with the full $10,000 under the RRSP withdrawal. This illustrates one of the biggest advantages of investing outside an RRSP for certain clients. The original investment can be recovered without creating additional taxable income. Only the investment earnings may be taxed, and depending on the type of investment income, the tax treatment may be even more favorable. Of course, this does not mean that non-registered investing is always better than an RRSP. Remember, RRSPs provide valuable tax deductions and tax-deferred growth, benefits that can be extremely powerful for many taxpayers. The real lesson is that tax advisors should compare both strategies over the client's entire lifetime. The best choice depends on future tax brackets, expected retirement income, government benefits, and the client's overall financial situation. In the next slide, we'll identify the types of clients who are most likely to benefit from saving outside an RRSP and explain why this strategy works well for some people, but not for everyone. We've now seen that non-registered investing can offer a very different tax outcome than an RRSP. But does that mean everyone should stop contributing to RRSPs? The answer is no. The best strategy always depends on the client's individual circumstances. Let's begin with the left side of the slide. One of the biggest advantages of saving outside an RRSP is flexibility. Money invested in a non-registered investment account can generally be withdrawn whenever the investor chooses. There is no requirement to convert the account into a RRIF, and there are no mandatory minimum withdrawals later in life. Compare that with an RRSP shown on the right. Every RRSP must eventually be converted into a RRIF by the end of the year in which the owner turns 71. Once that conversion takes place, mandatory withdrawals begin. Even if the retiree doesn't need the money, they must withdraw a minimum amount every year, and those withdrawals become taxable income. This can create two challenges. First, Mandatory RRIF withdrawals may push the retiree into a higher tax bracket. Second, the additional taxable income may increase the risk of losing part of their old age security through the OAS clawback. However, it's equally important to recognize that RRSPs still provide valuable benefits. Contributions generate immediate tax deductions. Investments grow on a tax-deferred basis. And for many Canadians who expect to retire in a lower tax bracket, RRSPs remain one of the best retirement savings tools available. That's why experienced tax advisors don't recommend the same strategy to every client. The middle section of the slide highlights the types of clients who may benefit most from saving outside an RRSP. For example, someone expecting a large pension, substantial retirement income, or a high future tax bracket may gain more flexibility by using non-registered investments. This strategy can also be attractive for clients who want to avoid mandatory RRIF withdrawals or reduce the risk of old age security clawbacks. The decision framework at the bottom summarizes the advisor's thought process. The first question is simple. What is the client's expected tax bracket in retirement? If retirement income is expected to be lower than today's income, an RRSP is often an excellent choice because contributions generate deductions at a higher tax rate, while withdrawals are taxed later at a lower rate. But if retirement income is expected to be similar to, or even higher than, today's income, the analysis becomes more complex. In those situations, a tax advisor should compare the lifetime results of an RRSP with alternatives, such as dividend compensation combined with non-registered investing. The objective is to identify the strategy that produces the lowest overall lifetime tax, not simply the largest deduction today. Finally, notice the retirement journey illustrated across the bottom of the slide. Everything begins with a corporation and the compensation decision. That decision determines how investments are funded. The investment strategy influences retirement income, and together these choices determine the client's lifetime tax burden. This is the central lesson of the entire section. Great tax planning is never about declaring one investment strategy superior to another. Instead, it is about understanding the client's complete financial picture and selecting the combination of compensation, investments, and retirement planning that produces the best long-term outcome. The ultimate goal is lifetime tax optimization. Every recommendation should answer one question: which strategy allows this particular client to keep the most after-tax wealth over the course of their entire life?